从8点开始说还是什么时候？Okay, we will start from 8
Okay.
p.m. Hello, tigers. So, hello, tigers. Okay, let's start. Okay, let's start. Hello, tigers. Welcome to watch today's live webinar. This is host Esther from Tiger Community. Today, we are happy to have two experts to talk about the latest observations and forecasts of the U.S. economy and the U.S. equity market. Welcome, tigers, to ask questions freely and share our webinar with your friends. First, let's welcome our main speakers to give an introduction of themselves. The first speaker is Professor Kevin Chen, who is based in New York City. Hi, Kevin. Welcome to introduce yourself and say hi to our audience.
Hi, everyone. I'm very happy and very honored to join the discussion today. So my name is Kevin Chen. I'm based in New York City. I'm currently the chief economist of Horizon Financial, and also we run some macro strategies. We have been investing across board from private sector to public listed vehicles. And also I'm on the several public traded company boards. And previously I was at Morgan Stanley, Amundi, etc. And also I've been teaching at New York University as an adjunct professor for 12 years now. I've been teaching global risk and also fintech. I look forward to share our views with you guys and also hear, maybe some questions from the host. Thanks.
Great, thank you. And our second guest is Brian Taikenko. He's based in Manila, Philippines. Hi, Brian. Welcome to share more about yourself and your company. Thanks.
Hi, Esther. Yeah, it's great to be here. Thanks for the opportunity to share ideas with our Tiger audience. I'm Brian Taikenko. I've been working with Stansberry Research. We're the largest independent research firm in the world with over 1 million subscribers reading our research. I cover mainly Asia and emerging markets, along with the commodities and technology. So yeah, this is a great opportunity for us to talk about the markets, and I'm honored to be here with Kevin and share our views with our Tiger viewers.
Many thanks, and look forward to all of you sharing tonight. Tonight we will we'll mainly cover 3 theme topics, as you can see on the slide. The first theme topic will mostly cover micro perspectives on your U.S. economy and the stock market. And the second is some industrial observations and earnings highlights for H2 2023. The third part will be some practical investing tips and experiences from our experts for Tigers. In total, we plan to spend about 50 minutes on the same topics, and we will probably leave 10 minutes for the final round of Q&A. And also, we also set aside 3 rounds of rewarding questions and for audience. Hope our audience will enjoy tonight's sharing and wish all you good luck. Okay, and now before we move on to our first theme, welcome Tigers to reply the first round of rewarding first round of rewarding questions shown on the slide. Do you agree with the statement that 5% to 10% equity market decline would be a buying opportunity for you? Welcome to answer the question. And the third, the sixth, and the ninth repliers in the comment section of this live stream will get rewards. Okay. Now, let's move to our first thing. And our first question regarding the same one will be, to Brian. Hi, Brian. Before this week, the August pullback caused people to wonder if the August curse had appeared. Is it real, or are there more macro factors, even black swan happened?
Okay, so allow me to share my screen for a while. Right. Yeah. Okay. So we saw a pullback in late July, August for the markets, and it seems like this is just nothing but more like a normal correction here. We've had the best performing global market year to date. We've been in a bull market since June. The S&P and NASDAQ are still up 15%, up 14%, and 27% respectively. And there are basically three reasons for this. You have one is the U.S. economy is still actually pretty good. Despite the rate hikes that the Fed has been doing, the economy accelerated to about 2.3%, 2.5% growth in the second quarter. That's one. So it's sort of weathering the rate hikes. Second is, earnings are actually coming in pretty well. 78% of the companies in the S&P have outperformed or exceeded expectations in the second quarter, and 6 out of 7 of the top companies in the S&P 500 have beat on revenues, and 7 out of 7 have actually beat on earnings. We had Apple, the only one missing on revenues, but everybody else like Microsoft, Google, Meta, and most recently NVIDIA beat earnings expectations by a mile. So this kind of sets the stage for further gains later on, and it explains why there's such huge optimism right now in the stock market. Third is, there's a growing optimism about the Fed finally letting off its foot of the brakes from the economy with their dot plot, showing that yes, we might see maybe a couple more rate hikes this year, 25 basis points to 50 basis points. But next year is looking more like 100 basis points to 150 basis point cut. Now, this all depends on inflation, which has been trending down. And if you've been following inflation, we still have to see one of the biggest contributor to the CPI basket, which is housing costs. It's actually trending down, but we still have to see this really impact on inflation. And I think there's a reason for that to be optimistic, because rental rates have actually increased previously to the highest levels not seen since 2003. And now that's sort of tapering off. When you have people no longer willing to pay higher rents, that one, and there's just basically not a lot of demand in the market right now at these prices, at these rental rates. So you sort of like have that easing off. Now we have that to figure into the CPI basket pretty soon. So everybody's going to be watching Jackson Hole, and we'll see what Fed Chairman Powell has to say. But I think the market's still going up.
Okay, so do you think that we should be bearish or bullish in the market in the Q3 or the second half of 2023?
Oh, definitely. We have reason to be bullish for the markets in the second half. Yeah.
Okay, great. Thank you for your sharing. So, Kevin, what's your opinion about the current and future market? Do you think the Fitch downgrades of U.S. Government bonds and the S&P downgrade of banks hurt the stock market's confidence?
Sure, yes, happy to talk about this. The Fitch downgrade of the U.S. Basic sovereign rating reminds me what happened in 2013, same time in the summer. In fact, almost the same date, which was early August. S&P downgrade U.S. government rating, and subsequently there was a major sell-off of the U.S. stock market, more than 10%, and global emerging market stocks down 20%. And then the U.S. Treasuries, in fact, rallied after U.S. government was downgraded. So this time, I would say it's similar in the sense that stock market initially reacted very badly. In particular names, for example, like Tesla, right, was down almost 20 to 30%. And emerging markets reacted badly too. However, this time the U.S. Treasuries did not go up. In fact, U.S. Treasuries went down too. So I would say the downgrade this time, in fact, to me, looks like impacted stock market, but also impacted the bond market. So it was not a purely a risk-off event in the sense that it was more a, I would say, a liquidity event that caused sell-off across stocks, bonds, and even gold. And I would say the impact to me looks like the yeah, and also dollar in fact went up, so dollar appreciated. So I would say in a summary, I would say this time the impact is more complex. However, looks like the impact toward the corporate is very limited. We're seeing the companies earnings from, they're handling this reasonably well, and I think people are expecting, I would say the downgrade kind of impact kind of tail off, and people are going to focus more on the earnings side. Yeah.
Yes, that makes sense. Let's return back to the liquidity or the inflation part. I want to invite Brian to cover what's the next for the Fed. Do you think the rate path will change in the second half?
I think the tone during the last meeting was that they remain very cautious about inflation. They're on guard for any uptick in inflation, which has been trending down. The market seems to be pricing in already a 25 to 50 basis point increase more this year. But then, yes, looking forward, we're seeing rate cuts next year. While the Fed's not really saying that, the dot plot seems to indicate that they are expecting rates to go down next year. So this is not the time to be bearish, it is time to be bullish.
Okay. And how about Kevin? Do you think there will be a rate cut very soon or next year?
Yeah, sure. So I would say it's I'll show you one chart from what I prepared. Okay, just so you can see that as of now, right, the market is expecting probably 1 to 2 more hikes, but 6% would be the top, and after that the market is expecting rate cut next year. And also next year is a election year, most likely. I would say the Fed probably does not want to cause a recession by aggressive rate hike. So most likely the rate is going to go down next year. And also, if you observe the CD, the deposit rate in the U.S., 1-year CD right now you can get at probably 5.5%. or sometimes even 6% for some smaller regional bank. But if you want to get 2 years CD, in fact, the rate right now for most banks are posting at something like 4%. If you take a mathematical average, right? So they're expecting by, in a year and a half, the rate is going to be more like between 3 to 4%. That's why the average the banks are offering 4%. So I would say from both the market expectation and also from the commercial banks, CD rate, etc., you're seeing the expectation of rate to go down next year, if not later this year.
Okay. Do you think the recent GDP expectation from the Atlanta Federal Reserve that announced the Q3 is going to grow by 5.8%? Do you think this is would be, if it realized, it would be the fastest pace since 2014? Can you give us some more interpretation of this prediction? Thank you.
Sure. Yeah, I'm happy to speak about this. GDP now is a real-time measurement of the U.S. GDP growth. Of course, right now they are looking at Q3 GDP, and Q3 we are really in the middle of Q3, only mid-August. So of course, no one can say for sure what's going to be GDP growth for Q3 this year. We haven't even finished the quarter yet. However, based on my conversation with the Atlanta Fed President Bostic over the years, he did come to New York City, to New York University, to give several speeches about the Fed economic outlook, and also he did talk about the GDP now. The model is not a forecast model. The model basically is a model that incorporates all the available data every week. That's why at the beginning of the month it's more volatile than the by the end of the quarter, because right now, let's say every month, every week, the new construction data, the employment data, the consumption, the export import inventory, etc. Because we don't have 100% complete data, we only have the partial data from some indicators. So those data could tilt the weekly number in a very dramatic way, upside and downside. That's why right now the data is very volatile. 5.8% growth is too high, obviously, and I think it's likely to come down. However, it does point at a higher GDP direction, which I believe is consistent with the job market now and also with investment. Some of the recent data, July, August data, you're seeing that some massive investment in the US in the manufacturing sector, something at a running rate of $2,000 billion per month now, investment in the infrastructure, in the manufacturing. And those are, I would say, what's driving probably the recent data surge. Of course, even the manufacturing investment to run at 6 times of 30 years average is very, very high, and I would say it's very abnormal. I don't think it's sustainable. So it is going to be, I would say, cool down a bit. However, the total number, I think, looks like to be a very strong quarter, which means I would say, again, back to the same topic we discussed with Brian earlier, that, you don't want to be bearish in a market clearly when you see strong economic data coming out constantly.
That's great. And I want to ask one more question for Brian. Do you think the oil price rose in July will continue to have influence for the coming months, especially for the inflation?
Oh yeah, energy prices look like they've already bottomed and look like they're going to continue rising, if not stabilize at these levels. Remember, you have the Strategic Petroleum Reserve refilling, underpinning oil prices there, plus the oil production cuts from OPEC being maintained. So it doesn't look like we're going to see lower energy prices going forward. We're actually going to see higher energy prices. How this figures into inflation, maybe see a slight uptick, but really, I think the market is looking forward to at least a gradual declining of inflation towards the rest of the year, despite higher oil prices.
Okay, thanks. If the recession expectation is fail, I think both of you maybe have confidence in U.S. economic too. May I recall back to the question to you, both of you? Is that a 5% or 10% decline? Would it be a buying opportunity for investors if the fundamental still good for Pacific stocks?
Oh, definitely. A 5 to 10% decline would be a buying opportunity for investors, and given the market fundamentals right now.
Okay, that's great. Okay, our sim one topic will stop here. That's bring some time for our audience. You can join a second round rewarding question. Yes, type your choices. In this round, the second and the eighth replies will be rewarded. Congratulations. Okay, let's start our second theme talking about the Q2 earnings seasons and the industrial opportunities in the next half of 2023. Based on the sector's year-to-date performance of 2023, I want to ask Brian first. Do you think the AI feast is over?
Okay.
Sorry for the mess.
I'd like to share my screen here for a while.
Yeah, and how should investors ride on this wave? Then later you can share what other industries and assets you think will continue to be bullish. Thank you.
Okay. Yeah, okay. So yeah, I don't think the AI wave is finished. I think yesterday's earnings release from NVIDIA proved that with another blowout quarter, beat on earnings, beat on revenues, and the indications are even for more of the same in the coming quarters. However, you know, these big names have shot up quite a bit this year. You have NVIDIA and a company like C3 AI having more than tripled so far this year. It just tells you just how young the market is, because a lot of, you know, most of the money is just going into a few names that are already established. So as the industry matures, you will start to see money flow out of these already very profitable positions into those new up and coming names. So it's not yet over. You know, with AI investments about to hit $200 billion by 2025, this is an industry you want to be in, but of course you got to be more selective. You know, you have a lot of failures out there. You still have a high degree of failure for AI startups. And that, again, that's why a lot of the money is still going into these established names. The way to ride this, I guess, would be later on, buying shares in a basket of companies that dabble both into AI and AI-related industries like automation and robotics. So these are industries that are established and still have a long runway for growth. Just look at industrial automation, for instance. It's set to double in size in the next 8 years. So these are mature markets you can ride alongside AI, and at least take out some of the volatility from just a pure AI perspective. So that's how I would approach this right now.
Okay, so do you want to add some what other industries or assets you think will continue to be bullish in the second half of 2023?
Okay, what other industries I expect to be positive in 2023?
Yes.
I see, again, semiconductors are going to be still one of the bright sectors in the industry. We've had sort of like a sell-off in the first half of this year, but with, you know, companies like TSMC now pushing 2 nanometer production, I mean, we're going to have a range of new applications that's going to open up a host of new demand for semiconductors. the outlook is still strong, 18% growth for the industry next year after a weak year this year. And you got a lot of the demand coming from China as well, despite the chip sanctions that are starting to get in place. You got a lot of companies that are ordering a lot more. Maybe this is figuring into some front loading, but then again, that's still demand right there. So the way to play this, I think, would be to buy shares in the ETFs like SOX, SMH, and SEMI. These are the ETFs to play in the semiconductor industry. One outlier I'd like to suggest also is the gaming entertainment industry. I think that this industry is also going to outperform in the second half of 2023. Again, the gambling market is huge. It's going to hit 1.4 trillion this year. You got the U.S. market, one of the biggest gambling markets in the world, hitting record highs this year. And China's full reopening has yet to play out. Macau was at one time generating, I think, 3 times the gaming revenue of Las Vegas alone. And you have companies here, the gross gaming revenues in Macau are still 50%, around 30 to 50% below their pre-pandemic levels. So you have a lot of upside there when it gets back to normal. So I'm bullish on this particular sector for the second half of 2023, and there are 2 ETFs to ride this: BJK and BTZ. So that's it.
Yeah, thank you for sharing. Definitely, I would add them to my watch list. Thank you. Let's turn to Kevin. How about you? Would you like to give some outlook first for the H2 and also share your recommend industrial or area that we should be looked to? Thanks.
Sure, I will be happy to do this. Let me just so as you can see that the stock market return at the first half of this year was pretty much driven by, I guess the negative Fed policy, but also positive sentiment. And the positive sentiment pretty much concentrated in the AI related stocks. Without AI, the 11 AI stocks, the remaining S&P for the first 7 months of the stocks, in fact, they did not deliver positive return. And I think the second quarter is likely to be, the second half of this year is likely to be different, in the sense that I think we will have more participation in the stock market upside, in addition to the AI stock. You cannot have everything to be in the AI. And also the earnings across board, I would say, so far are not bad at all. Specifically sectors, I would like to mention a couple of sectors. Obviously, I'm involved with. I like to mention about them. One is, I would say, fintech. Fintech as a sector, I would say, was sold off very, very aggressively. Was sold off last year. And I would say people were too pessimistic last year. And I think the market, the fintech sector is recovering now. And I think it's going to recover a lot more, whether it's about online trading, it's about insure tech, and the SAS, SaaS insurance service, healthcare insurance, etc. Across board, I would say fintech related sector is an area I would pay attention to. And the second area is I would say related to healthcare. Since COVID the epidemic, there have been a lot of innovation in the biotech space or in healthcare in general. And I would say a lot of the, of course, the biotech names sold off very, very aggressively last year. I would say a lot of companies, they're trading at a market cap below the cash they have on hand, which is not, it's really, I would say, an anomaly. And many of those companies, from smaller biotech to large pharmaceutical companies, they do have very strong pipeline in the new drug development, in cell therapy, in the, I would say, treatment of, a lot of different disease, including cancer, including Alzheimer and all those, diabetes, etc. And all those are going to translate to a lot stronger earning going forward. And I would pay attention to the healthcare sector, including biotech going forward. Yeah, that's outlook I would say that I'm looking at. Yeah.
Okay, would you add up some comment on the Inflation Cut Act and the CHIPS Act? What details, industries, companies we can benefit from this continually?
Of course, yes. So I did participate the IRA, Inflation Reduction Act conference last year in West Virginia, and also earlier this year, early May, during the annual meeting, shareholder meeting of Berkshire Hathaway. Mr. Warren Buffett even talked about their investment in the renewable energy. So I would count renewable energy as a major sector that's benefiting from Inflation Reduction Act. So which includes, of course, the EV, electronic vehicles, the charging stations, the solar panel, the wind panel. I would say all those renewable energy related sector, both in the manufacturing sector, but also in the sector that's directly in the service, like charging stations. And also, I would say, it's a very interesting phenomenon that the renewable sector, the EVs, they are linked toward AI as well. Even Tesla has very strong AI built in the self-driving, driverless vehicles, etc. So all those, I would say, benefiting from the Inflation Reduction Act. And but the Inflation Reduction Act is not only just about the renewable energy. It does cover, I would say, the broader based manufacturing in the U.S. The massive wave of new investment in the infrastructure in the manufacturing sector are going to be very bullish for those equipment makers. Things like Caterpillar and all those names. You can see that their earnings are really benefiting from the Inflation Reduction Act's incentive for the manufacturing activities in the U.S. And last part, the IRA, Inflation Reduction Act, and CHIPS Act, they did include more, I would say, welfare benefits to the workers in the U.S., including a reduction of the healthcare payment. And also, I was increase of the salaries, compensations for the workers, and all those are going to be the drivers for the economy going forward. So I would say definitely pay attention to the sectors that that's benefiting from IRA and CHIPS Act.
Great. And for investors, we can look into the public news and the reports to find many benefit stocks for their own as well. So thank you for Kevin. So let me ask both of you, because you two are experts of Asia market. I want let Brian talk first. What key factors do you think will affect the markets of Chinese ADRs in the future? And do you have any comments or suggestions?
Okay, we just got through like a slew of earnings for China ADRs, and they've, for the most part, been very good. You had a few misses, like from companies like Tencent, but then for the most part, like Alibaba, you got the e-commerce plays. Pinduoduo Pinduoduo is not yet released, but they're about to release next week, and they've been consistently outperforming. But for the most part, e-commerce plays, Kuaishou, you got like Alibaba again, JD.com, doing really well on the earnings front. And what we're seeing now is, like I've been saying for a while now, these companies have already gone through a period of 2 years of adjustment to regulations, and now they're starting to show that they can grow within these regulations. And now Beijing is throwing the Chinese government. Now it's at least signifying its support for the industry as the industry that can help China get out of its dilemma right now with the slowing manufacturing and real estate sectors. So they're promoting innovation. That's very good for these companies, mostly Chinese ADRs that are tech. And the earnings outlook is actually getting better as we head down towards the second half of the year. So I'm pretty bullish on Chinese ADRs with the tech industry.
Okay, Kevin, thank you. And Kevin, do you have some more to add up? Thanks.
Sure, yeah. So yeah, for the ADRs or for the Asia equities in general, I would say investors globally, they are looking for growth, right? When, of course, if you are looking for safety, you go to buy bonds. If you're buying stocks, you're really looking for the upside, for growth. And a lot of the Asia stocks, they do have strong growth, and that's what people like. So I think the thesis is right. And how to improve those stocks, I guess, going forward. A couple of things, right? One is improve the disclosure, increase the communication with shareholders. I would say more, transparency is always better for the shareholders to understand the company better. First. Second is to increase the buybacks and the dividend. Look at comparison to the very large cap tech stocks in the US. They're all doing massive amount of buybacks and also dividend. Even yesterday, when Nvidia announced a very strong earning, they also announced they are going to buy back stocks. And that's a very strong positive for stock market and for the shareholders. And I believe the Asia equities, those very large tech names, they do have a lot of cash, and if they can do more buybacks and dividends, that will be very good for the shareholders, and obviously it will be good for the stock price as well.
Okay. Particularly, do you have your own long-term watch list you can share with our tigers? Thank you.
Yeah, for me, I would say, those leading stocks on this list, on the screen, I think all those are very good names. Looks like I think, these are the names that's pretty much overlapping with what I like. And of course, we still need to look at the valuation as well. If the valuation is too high, you probably want to be more cautious. And also look at PEG, not only just earning, but also earning growth. Yeah.
Thank you for the sharing. And we will move to our final theme topics, which is about your experts' practical skills and experience for investors. And before we start, our guests can take a small break now, and we will welcome audience to reply to the final rewarding question. Are you a long-term investor or a short-term investor? Lucky winners with the 5th and the 10th replies will be rewarded. And thank you for all our audience listening. Okay, okay. Okay, let me invite Brian to talk again. As a top-down fundamental long-term investor, what's the most important thing before you make a decision to trade a stock? Would you like to share?
Yeah, okay. Let me just share my screen here. I have a few bullet points here to share. Okay.
Yeah.
Basically, I'm a top-down analyst, so you normally take a look at the macro first, and I believe that if you take care of the macro, the micro takes care of itself. That means you get in the right markets, you get into growing markets, then you have a better chance of success. So that's what I saw 20 years ago when I started covering China. The U.S. has always been a growth market. and now proving to be another growth market with the recent GDP figures. So there's always opportunities in these markets. So what's important is before you do any investment, make sure you know what the risks are, where your exit strategies are, at what price you want to get out, and make sure to have stop losses in place, because your primary goal in investing is to protect your capital before anything else. And then make sure you're decisive. You stick to these stop losses. When it's time to sell, you sell, and when you make when you make a decision to buy, then you buy. And I always believe that dollar cost averaging works. You don't just put all your money into one price. We don't time the markets. It's hard to do that. So make sure if you find a good company, you keep on buying at different price points. That way, you're able to get a better average for your cost. And when your investment thesis plays out, you'll maximize your returns. Yeah.
Okay. Could you share some special tips or suggestions for long-term or short-term investors in current time?
Whether you're a long-term investor or a short-term investor, one of the most important things to do is look at the economy. And what we see right now is a growing economy in the U.S. China is still growing. It's facing its own difficulties, but still, their target is 5%. I think some brokers have their targets lower at about 4.5% after seeing what happened to real estate. But 4.5%, 5% for an $18 billion economy is still considerable growth, and within that, there's a lot of potential. So whether you're short-term or long-term oriented, it pays well to look at the economy and the fundamentals, and that's where you make your decision whether you buy for the short-term or the long-term. Of course, I'm not a trader, so I always invest for the long-term.
Okay, thank you. So do you think the current US dollar and the US pound will continue to go high, and how should investors plan their investments based on this part? Thank you.
I believe that the US dollar has sort of been overplayed. The strength has been overplayed, and a lot of the strength there has been due to the expectations of rising rates. But with the expectations now for weaker inflation, you're going to have start to see some weakness in the dollar and the strength in risk assets. And normally, when the dollar is going down, you have an outperformance in risk assets like emerging markets and China as well. So that's why one of the reasons why I'm also still continue to be bullish on China and emerging markets, because I feel that with the dollar now looking to be weaker, these risk assets are going to outperform.
Okay, thank you. Let me ask Kevin, what's the most important thing for you to do before you decide to trade?
Sure. Yeah. I share a very similar approach to Brian in the sense that ultimately it's really about fundamentals. And stock market investment is not some kind of get rich quick scheme. And you actually will realize over the long term, the stock market, they do, price-wise, they do come back to the fundamentals. And what are the fundamentals? The fundamentals are really, earning and the valuation, right? And if the earning is strong, then the stock is going to likely go up. And then if the valuation is too high, it's likely to revert back toward a long-term average. So I guess as long as you are diversified, and as long as you are buying stocks with earnings, with reasonable valuation, and and then I guess average in, or in a staged in, reduce the cost, when you are entering a position. I think that's a very, very good long-term approach. And ultimately, you will be a winner in the stock market if you can follow these principles. They sound simple, sound easy, but it's not easy.
Yeah, that really makes sense. But you also think that we should apply some hedge strategies? What's your
Yeah, I think, the good thing about the US listed stocks, including ADRs, is that the options are very, very liquid and a very active market. Definitely, it's a tool that you want to use, both from the protecting downside and participating to the upside. So I would, yes, I would agree with this that, using options is a good part of overall investment strategy.
Okay. Could you, we know that you also share many courses online, which is about industrial analysis. Could you select a potential bullish industrial and tell tigers how to find the most potential one and how to do risk management and position management? Thanks.
Yeah, sure. Yes, I do. I do teach some of those investment analysis courses. I would say, there are many I would say key approaches that stock market investors should follow. I would say one of the most important things is diversification, because diversification is pretty much the only free lunch on Wall Street. You want to be diversified because you don't want to put all your eggs in the one basket, even though you could have a very, very strong conviction on any stock, any one single stock. But if you concentrate all your money, all your capital into one stock, you never know what could happen to this stock. So diversification is very, very important. And then after that, after you are diversified, then you can choose your different positions. And then by then you need to look at the earnings growth, cash dividend, valuation, and obviously there's also the currency risk you need to consider. I do believe that right now the US dollar is at extremely high valuation. It's not because the US dollar is strong. It's more because of other countries' currencies are very weak, including euro depreciate 30% plus, including Japanese yen depreciate 30% plus, and all pretty much driven by the Fed aggressive interest rate hike. So if we believe that next year the currency, the rate hike is going to be less, and highly likely that the Fed could cut the rate, dollar might not be as strong next year, which means you can actually start to think about diversifying your currency exposure now as well. So all those are the things you need to pay attention, and either pick up some books or those online classes. All those would be very, very helpful for investor. A lifelong learning is also a winning approach for any investor.
Yeah, thank you. And can I ask both of you two more questions about the how to trade the earnings seasons? Yeah, each time people are crowding to find the target stocks. Do you have any suggestions and any good tips for investors? Thanks. Maybe
I'll go
first.
When you say trading the earnings season means don't speculate on what a company will do. If it's been outperforming consistently, then there's a good chance it will continue to outperform. But of course, when you have to keep a close eye on the earnings. When they release earnings, you have to really parse the data there and see if they're continuing to grow at a way that you expected them to. If the fundamentals change, then you have to change your strategy. That's just it.
Yeah. How about Kevin?
Yeah, sure. So I would say not necessarily hedging strategy, but before those earnings time, if you already own a stock, I think a covered call would make a lot of sense, because before the earnings release, right, the implied volatility is very high. So if you have the stocks already, do some covered call strategy, that's a good way to add some yield to your position.
Yes, we have many courses about these options strategies in our community. Okay, thank you for Brian and Kevin sharing. I think our time for now is it's fine. But both of you, do you have any question to discuss more about the market?
Not for me. Yeah, we can have more questions.
Okay.
Not really. No.
Okay, thank you. Actually, I think but we have learned a lot today. Thank you for all audience listening, and congratulations to the Tigers who won the prize. So, and the Tiger community will editor and share and publish the highlights of today's live under two guest accounts, and we'll post in the community. Feel free to follow our two guests and to ask more questions for communication. Thank you for all your listening. We'll see you next time. Bye bye. Thank you, Kevin. Thank you, Brian.